Considering the existing uncertainty, we should not set in stone this very loose monetary policy stance for too long.
It's a regulatory process that I would expect that it will be a long march. Not only in China, also around the world.
One of the jobs of an international bank is to comply with complex laws and sanctions laws wherever they're implemented. And that complexity has increased.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 2nd of September. I'm Francine Lacqua in London, and here's what's coming up on today's program. China continues its assault on tech. Beijing orders Meituan and Didi to rectify instances of misconduct by year-end. Tech names pair gains in Hong Kong. Apple folds on its 30% commission fee for media apps like Netflix after facing global antitrust scrutiny, but it will still collect money on games and in-app purchases. And investment garbage, while erstwhile bond king Bill Gross talks trash about treasuries, rates rebound after initial sell-off. So let's get straight to the markets, and European stocks searching for a direction after fresh regulatory assaults on Chinese tech names really sapped some of the positivity from the markets. Now, this comes after the big U.S. tech stocks rallying yesterday, sending the Nasdaq 100 to an all-time high. The broader S&P was actually a little changed as data suggests U.S. companies added fewer jobs than expected in August. Now, let's get straight to the markets now with our Ritika Gupta. So, Ritika, what are we actually seeing in terms of the China tech bounce back?
Well, Francine, I'm going to start off with just looking at where we are in Europe and the US here. So first of all, looking at Europe, it's shaping out to be a stronger session, up some 0.3%, extending those gains from yesterday. And if we look at S&P minis here, also up nearly 0.2% here as well. That was after yesterday a bit more of a lackluster session for the S&P 500. It was those ADP jobs figures that were weaker than expected. So a lot of focus in on the non-farm payrolls jobs out tomorrow. It really was the Nasdaq that was leading the charge higher yesterday, really by those mega cap tech names. So a hint of defensiveness really coming into this market. And you see that when you look at the yield space back below 130 on the 10-year. But we do have the likes of Bill Gross and JP Morgan saying that they see yields going to 2%, 1.9% respectively. But we have heard that all before, as you know. And then I point just to crude, taking a look at that, pretty much flat. But we did drop after those OPEC Plus meetings that said they would continue to stick with those hikes as planned. Let's take a look, as you asked, about the Chinese market as well. I take a look at the Hang Seng Tech Index. We did pair some of those rallies. This is after that continued crackdown on Didi and some of those ride-hailing apps. But if you look at the past 4 days on the Hang Seng Tech Index, really have had a pretty strong rally here. We've seen funds coming in from abroad, some pretty attractive valuations. So you're seeing investors coming in and scooping them up here. There's a lot of questions as to where tech in China goes from here, but we have kind of bottomed because there's a question of whether companies learn to live with some of these regulations. In the long term, could industries actually do better with them? But if you look at the August, we had some lows there. We're up some at 19% from there. And from February, where we have a real downtrend, just seem to be now breaking out of that now, Francine.
Ritika, thanks so much. Ritika Gupta there with some of the market moves. Now, two of those companies Ritika just mentioned, Didi and Meituan, part of a group of 11 firms that Chinese regulators have criticized for allegedly disturbing fair competition. Now, they have been ordered to rectify instances of misconduct by December, amping up scrutiny over an industry that employs millions. That comes as Chinese firms rush to embrace President Xi's common prosperity slogan. Now, scores are name-checking the phrase in their earnings, but as companies learn to live with the new era of regulations, the president of Hong Kong's stock exchange sees other countries following China's lead in regulatory reform.
It's a regulatory process that I would expect that it will be a long march. Not only in China, also around the world, because it's an area of a lot of sensitivity, whether it's the data, the privacy of information, whether it's national security, whether it's issues of like how to regulate companies that have monopolistic powers. This is something that we will probably continue seeing.
Now, for more on all of this, we're joined by our chief Asia economics correspondent, Enda Curran in Hong Kong. Enda, so what exactly, first of all, good morning. What exactly is the significance of the meetings with Meituan and Didi?
Well, it is significant. These complaints this time around, Francine, range around data protection. They're talking about the use of unlicensed drivers. There's a reference to vicious competition that threatens safety. So it's going again to this idea of consumer protection, and that's all about feeding into the broader idea of common prosperity. Remember, China's government now is very serious about getting these technology giants to pay their way and to play their part in making a more equal society and to tackle inequality. And we've seen several big tech companies now, quite apart from making financial payments towards this effort, they're also increasingly referencing the whole government push around common prosperity. So it's certainly looking like a joined up approach. And this latest kind of slapdown of the rideshare companies is an example of that. And they have until the end of this year to get their house in order.
So we also had some news on extra stimulus. How important is that?
Well, that's right, Francine. The State Council came out, the equivalent of a government cabinet here in China. They came out and they made this point that the central bank needs to get cheaper loans into smaller and medium-sized businesses. They're talking about $46 billion worth of loans. That clearly speaks to the idea that the authorities do see a slowdown there and they do see the need now for extra support. There will also be some other measures such as more local government borrowing to get those infrastructure projects off the ground. And it adds to the idea that the authorities are certainly trying to tackle those sectors that are most exposed to pain. And we know that medium-sized businesses are getting hurt by rising commodity prices and, of course, the whole ongoing supply chain squeeze that's hurting the manufacturing sector. We know there's been a hit to the services side of things as well. But what this isn't, Francine, is it's not a major stimulus. It's just kind of support and a nudge to make sure the economy keeps on track for that 6% growth level at the target that the government has set. And clearly, the overall story is that the economy does remain on track for that target right now.
Enda, thank you so much. Enda Curran, our Chief Asia Economics Correspondent in Hong Kong. Now we're joined by Silvia Ardagna, Head of European Economics Research at Barclays. Silvia, thank you for joining us. I don't exactly know how economists should view China right now. Is this a possible slowdown that will be managed, given all the complexities of China by authorities, or could it actually, hurt the world economy as a whole?
Good morning, and thanks for inviting me. Look, our view is that this slowdown in China will have marginal impact for the rest of the world. Obviously, China is a very important trading partner for Europe, and foreign demand will be impacted through this channel. But at the same time, we think that the strong rebound in the service sector, given government's reopening of the services contact activity firms is going to be the first order important factor. What is relevant also for European economies and clear the global economy is the fact that the Chinese government is imposing restrictions to reduce the spread of the virus, and this can add up to supply side bottlenecks that we see already.
Silvia, what's your main concern when it comes to the world economy? So I know, we talk about the Delta variant, we talk about, possible resurgent virus, vaccination rates. Supply chains is probably the big unknown that could filter through inflation or not. Like, what are the bottlenecks of these supply chains and how long do you think they'll last?
Certainly, this is quite relevant at the moment. As at the time being, we think that this can last into the first half of next year, given that the virus in developing countries is clearly not under control. However, we still think that these effects are going to be temporary. So yes, temporary, that is longer than a month, it becomes to be a concern. But we think that the monetary authority will still look through this, because as the pandemic gets more under control and economies reopen, the supply chain bottlenecks should gradually ease. And it's interesting that the latest PMI surveys for Europe show some easiness of the supply side bottlenecks.
So what does that mean for your, inflation expectations? I don't know whether I ask you about the US or just, inflationary pressures worldwide filtering through the US.
Well, we have revised upward, for example, our inflation forecast for Europe for the next few months to account for the impact of supply side chain. Inflation is likely to remain higher in the US as well and to go down gradually in Q2, for example, in Europe next year. So it has an effect, but we don't see it having a second round effect. What means is that we don't think that at the moment this supply side effect on current inflation are feeding through inflation expectations for the medium term, nor into wage dynamics.
Silvia, thanks so much. Silvia Ardagna there from Barclays stays with us. Coming up, ECB policymakers spar over ending stimulus amid a rise in inflation in Europe. So we'll discuss that next. And don't miss our exclusive interview with the HSBC Chief Executive, Noel Quinn. It's tonight. You can catch it first, the full interview on the Bloomberg terminal starting at 11 p.m. London time. Then starting at midnight, clips will, of course, appear on Bloomberg TV and Bloomberg Radio and all of our other platforms. It's one of the very first times that actually Noel Quinn sits down with any journalist since he's become chief executive. This is Bloomberg.
Wir sollten eben auch das Risiko.
We should also not ignore the risk of excessive inflation. Considering the existing uncertainty, we should not set in stone this very loose monetary policy stance for too long.
Well, that was Jens Weidmann, of course, of the Bundesbank, weighing in on intensifying debate over when to end stimulus ahead of the ECB's policy meeting next week. Now let's get back to Silvia Ardagna from Barclays. Silvia, a number of the hawks actually came out in the last couple of days saying we need to talk about tapering, we need to start normalizing, and we certainly need, some of them say, to start normalizing, especially the things that were put in place because of the pandemic. I mean, how do you see the ECB operating in this?
We agree that the stimulus that is provided via the PEP pandemic program is going to be scaled down at this meeting. We expect that, we have expected that in a long time, but we disagree with the fact that this has to be interpreted with a proper tapering. And we think that the monetary policy stance will remain loose for long because, as I was saying before, this spike in inflation is likely to be transitory. So in our view, the ECB will scale down the PEP at this meeting, but will also hint that when PEP ends in March, there will be a recalibration of the normal APP program. It will be important to look at the inflation forecast because these in the medium term, so the inflation forecast for 2022, 2023 in particular, because this will signal that inflation will be still quite low in the medium term from the new 2% objective that the ECB has set.
Silvia, is there I don't know whether there's a danger or concern or just something we need to look at, but what we saw from the Bank of Korea actually hiking rates, that was last week or maybe 10 days ago, are we going to see, smaller open central banks starting to do that? And will it put extra pressure on the ECB and the Fed to start moving?
Look, I don't think that the small central banks put pressure on ECB or the Fed. I mean, after all, these central banks manage their own domestic economies, and we have a large, close economy, particularly for the US. It is true that some central banks have already started the hiking cycle, but clearly they have different growth or mainly inflation situations than what we have in Europe or what the US has. And Europe and the US are at different stages of the recovery. We completely agree with the president of the ECB that has in the past highlighted that repeatedly. So the Fed in our forecast will announce tapering at the September meeting. We don't think that the scale down of PEP should really be interpreted as tapering for the euro area, but just as a reduction of this emergency program that will then still leave monetary policy loose for long.
Silvia, one of the things I love the most is when actually viewers write in and they ask me to ask you questions. So please, everyone who's watching, Silvia is one of the smartest economists we have on. So please ask as many questions as you want. Silvia, this person's writing in, and this kind of touches on current affairs, but it's also about security, access to the energy. So this person writes in, with the current affairs in the Nord Stream 2, how does Silvia see this affecting trade across Europe?
Well, this is clearly a very interesting question. I would say outside the scope maybe of what our research has done, but we see trade in the euro area being still a very important channel for economic activity. Clearly, as I was saying before, trade will, export are likely to be affected more by the pandemic in the near term than by any of these other concerns. It will be important when we look into, next year and the future. What stance also the new German government can take on foreign affairs, but again, might be too soon to say. The uncertainty is high on this front, even on what kind of coalition agreement we will get.
Yeah, I was going to ask you also about, Germany, Silvia. We have big elections also in 7 months in France. How difficult is it, to have a unified economic forecast for Europe where it's such a big 12 months ahead?
I mean, there are uncertainties that any elections poses to the fiscal policy stance, but in our baseline view, even different German coalition are going to play a difference at the margins on the fiscal policy stance. But clearly, we will not see for 2022 or 2023 any transformation into the main fiscal policy picture that we will have in the European area. And this is particularly obviously for 2022. The new government will do, mainly the 2023 and onward budget. But in our view, fiscal policy will remain expansionary across the euro area, but the amount of support will be gradually scaled down with the improvement of the economic outlook. We are luckier in a sense time that we have the NGU, and so this fiscal facility that is at the European level, which is about to last for 6 years. So at least this is insulated by the current elections affairs in the various European countries.
Silvia, thank you for that. So let's also listen to what PIMCO co-founder Bill Gross has dubbed the bond market investment garbage. He said in his latest investment outlook, cash has been trash for a long time, but there are now new contenders. Intermediate to long-term bond funds are in that trash receptacle for sure, but will stocks follow? Silvia, how much do you look actually at market activity to try and figure out what the markets understand differently to economists?
Look, clearly, the market in the past, few sessions have been more concerned maybe than our economic narratives, and this might be certainly a reflection of the virus not being under control and fear of supply side bottlenecks feeding into inflation, maybe reassessing the probability of tapering in the US. But having said that, treasuries are still quite low in absolute levels, and I think the improvement in the US economy and global economies clearly undeniable, and so maybe markets are also beginning to take stock of that.
Silvia, thanks so much. Silvia Ardagna, their head of European economics research at Barclays. Now, coming up, a first look at Bloomberg exclusive. We'll hear from our interview with the Hsbc chief executive, Noel Quinn, in his first since taking over the role. That's coming up shortly, and this is Bloomberg.
One of the jobs of an international bank is to comply with complex laws and sanctions laws wherever they're implemented. And that complexity has increased, but we'll navigate that as we have done so far, and we'll continue to do so going forward.
Hsbc Chief Executive Noel Quinn there speaking to us exclusively, and you can catch that full interview first on the Bloomberg terminal starting at 11 p.m. London time. Then starting at midnight tonight, you'll see it on television, Bloomberg Radio as well, and all of our other platforms. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. New York and New Jersey have declared states of emergency due to record-breaking rains as the remnants of Hurricane Ida pummeled the region. Manhattan's Central Park got 3 inches of rain within just 1 hour, while Newark Airport in New Jersey got more than 6 inches in 3 hours, roughly the equivalent of 7 weeks of average rainfall. The flooding has halted train services, downed trees, and even swamped the streets. Now, the U.S. Supreme Court refused to block a Texas law outlawing most abortions after 6 weeks of pregnancy in a 5-4 ruling. The rejection marks a watershed moment, allowing a law to stand that is at odds with previous rulings that protected abortion rights until much later on in the pregnancy. The order hints the conservative court may be ready to overturn the landmark 1973 Roe versus Wade ruling. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, coming up, Apple and Google are facing refreshed global antitrust scrutiny over their market dominance on mobile platforms. We discuss the implications of this next. This is Bloomberg. China continues its assaults on tech. Beijing orders Meituan and Didi to rectify instances of misconduct by year-end. Tech names pair gains in Hong Kong. Apple folds on its 30% commission fee for media apps like Netflix after facing global antitrust scrutiny, but it will still collect money on games and in-app purchases. And the chief executive of the Hong Kong Stock Exchange sees China's regulatory reform continuing and governments around the world following suit. This evening, we'll also hear from my exclusive interview with the Hsbc chief executive, Noel Quinn. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it's all about data out of the U.S. tomorrow. That's the big one, and it's U.S. jobs. But right now, we did have a bit of a wobble just because of what we saw in Asia. This is on more regulation hitting tech stocks. Actually, tech stocks in Asia not doing too badly at the moment. This is a picture for Europe, so you can see the European stock 600. Tentative gains, I would call it, 0.2% higher. The focus is a lot on the travel stocks, for example, as there does seem to be a bit of buoyancy now in economic prospects, that the Delta variant has been a concern, but actually won't really derail the economy. That's the juxtaposition with concerns about inflation. Nasdaq Futures also holding on some of the gains. I love the 10-year yield. We'll spend a lot of time talking about Bill Gross, talking treasuries are trash, 129.70, and Bitcoin. Always look at Bitcoin. It's gaining over $50,000. Now, let's turn to China. Didi and Meituan are part of a group of 11 firms that Chinese regulators have criticized for allegedly disturbing fair competition. Now, they have been ordered to rectify instances of misconduct by December, amping up scrutiny over an industry that employs billions. The changing regulatory environment is also top of mind for another big company in the region, while Hong Kong's exchange chief executive spoke exclusively to Bloomberg's Stephen Engel about China's regulatory reform and its impact.
The regulatory reforms that we're seeing in China is something that we're going to see continuing for quite a bit of time. But it's not only China. As it relates to data, as it relates to big tech, it's a regulatory process that I would expect that it will be a long march. Not only in China, also around the world, because it's an area of a lot of sensitivity, whether it's the data, the privacy of information, whether it's national security, whether it's issues of like how to regulate companies that have monopolistic powers. This is something that we will probably continue seeing.
We heard in July that perhaps listings that will come to the Hong Kong Exchange will have less of a cybersecurity review than, say, those companies that go to the United States. Is that a fact, and how is that affecting or potentially boosting listings here?
Yeah, I think it'll be consistent all around. I mean, the rules will be applied consistently.
Consistently with those going to the U.S.
around
and Hong Kong?
Any companies that they will, yes. I mean,
so Hong Kong will not have that advantage?
I don't think that will be the advantage, because, I mean, essentially the companies will need to make sure that they protect their data, that they are confident that that data is secure. It cannot be permeated to other areas. So, I mean, the likelihood of having that as a very, very specific advantage, I think it's very low. I mean, I would think that there will be a consistent application of the rules and regulations.
Now, we're hearing from the likes of Citibank and other analysts saying there's about $637 billion of market cap of Chinese ADRs potentially who have not come back to Hong Kong, have not returned onshore back here to Hong Kong. What are you seeing with those companies that were thinking of a U.S. listing, like Xiaohongshu, among others, Lala Move? Are you seeing that pipeline increasing, given that there's a lot of companies that potentially would find regulatory scrutiny in the United States too difficult and would want to come back here?
Yeah. I mean, absolutely. We've seen quite a significant increase in terms of inquiries. And companies that were originally thinking about the US are now inquiring about Hong Kong. Some of them have already switched and started focusing on Hong Kong. I mean, part of this is the regulatory pressure from the US in some cases as a result of the accounting disclosures and the needs. Others feel that, I mean, it's easier to be closer to their home market. So it's a combination of things. And I would expect that in the medium term, we'll probably have companies listing in both venues. I don't think that it's going to be all Hong Kong, and I think that's actually healthy for the market.
What about longer term?
Yeah, same thing. I mean, medium term, long term. In the short term, probably there'll be more towards Hong Kong. Medium to long term, I think it'll be a balanced, approach.
The Hong Kong Exchange Chief Executive Nicolas Aguzin there, speaking with our Chief North Asia Correspondent Stephen Engel. Now, Apple will allow app developers to link their software to external websites for payments and avoid a 30% fee. Now, the announcement comes at a time of rising global antitrust scrutiny of Apple and Google's dominance on mobile platforms. On Tuesday, a new bill was also passed in South Korea. The U.S. Justice Department may file an antitrust lawsuit over Google's digital ad practices as soon as the end of the year. Well, joining us now to talk about all of this is Bloomberg Intelligence's Matt Blocks. And Matt, you always make us smarter on this. Now, this feels like a really big deal because in the past, you basically, if you bought an app through the Apple Store, Apple automatically got 30%. No longer the case, but for a select few app stores. Is that right?
Yeah, that's right. So it's only for what they call kind of reader apps, so kind of publishing, includes things like Netflix and Spotify, but also kind of magazines. It only accounts for maybe about 10 to 15% of the revenues they generate from their in-app purchases. So it's a relatively small amount. And I think for people like Netflix, not that significant in the short term because they've pushed their subscribers to pay on their own platform. But going forward, Netflix has said they want a much bigger share of the mobile market. So this may help them to kind of offer different ways of actually buying the app and using the service going forward. So yeah, it's short term, not a big impact really.
But could it have an impact longer term because we're going to see more regulatory scrutiny on Apple?
That's right. I mean, as you said, we've seen a move in South Korea. This was in response to a similar investigation in Japan. India's opened an investigation. There's this new US investigation. So I think it's part of a long-term theme that the dominance that Apple, Google and others have enjoyed is being attacked by regulators because there simply isn't the competition to do it through market forces.
I mean, is it going to be the Asian regulators, European ones, or are we seeing more things in the US because of the Democrats?
I think it's all of them, and it's just simply, which door opens first, really, that kind of forces a change. It's interesting that Apple's doing this on a global basis in response to a specific Japanese investigation. So I think, perhaps we might see something in Europe next year which will force a similar global change in a different area. So I think it's just going to probably be specific country investigations that force these global changes over the next few years.
Matt, what about Google?
Well, it's a kind of similar thing, really. I mean, they're hugely dominant in the ad tech market. This new investigation is around ad technology, so how they help advertisers and publishers kind of come together to make that market. They probably take about 30% or so of that global digital ad market, so they're strong together with Facebook.
The figures are incredible.
Them and Facebook together is 50% at least, so they're kind of really quite dominant. So it's a similar issue. It's all about platforms. That's just a different type of platform. They have an incredibly strong share. As an advertiser, you wouldn't think of not advertising on a Google platform. So again, it's this issue of control, and not so much that you're dominant. It's whether you're abusing that dominant position. So that's what the investigation is going to look at. So I think you may well see more voluntary concessions from Google over the next year or two to kind of avoid a kind of harsher regulatory imposition of rules.
So, Matt, what's going on with regulators? I mean, have they always tried to regulate, cases like this, or is it that the tech companies have become bigger, or that regulators have become smarter about what they actually do and how they operate?
I think the regulators, as is often the case, are catching up with what's happening in the real world. And I think because the digital ad companies have become so powerful, they've been kind of forced to act. I think historically the kind of tools they've got to work with as regulators haven't really been fit for purpose for the digital world, and they're scrambling to adapt what they've got and to create new legislation to reflect the reality of the world we're in today, which is these huge dominant tech companies.
Matt, thank you so much. Matt Bloxham there from Bloomberg Intelligence on all things tech. Now, coming up, can diamonds be ESG's best friend? Well, we'll discuss why lab-grown diamonds may not be the green way forward for the traditional mining industry. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Wells Fargo has pushed back its return to office plans by 2 more weeks to mid-October. The company, which has the most employees of any US bank, will now start bringing back staffers who have been working remotely starting on the 18th of October. Shares of Netflix rose to its highest since January on the announcement that the platform will be streaming popular sitcom Seinfeld starting on the 1st of October. The debut of the famous show about nothing has been long awaited. Netflix won the rights to all 180 episodes in 2019, and Bloomberg Intelligence writes the show's arrival may be a key catalyst for user growth. And Paramount has delayed the release of the Top Gun sequel into next year as Hollywood continues to wrestle with the pandemic that has kept many people from theaters. The film starring Tom Cruise was expected to debut in November and will instead now move to May. The studio plans to release it exclusively in cinemas rather than pursue a simultaneous release on a streaming service. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, the diamond mining industry has not been short of sustainability criticism. According to Alrosa, the world's largest diamond miner by volumes and carats, there's a growing misconception that lab-grown diamonds are the industry's green solution. Pandora recently announced it would sell exclusively man-made diamonds. But Alrosa argues synthetic diamonds are not a sustainable replica of the natural mined mineral. Well, we're now joined by Alrosa's independent director, Maria Gordon. Maria, thank you so much for joining us. Now, this is, a part of the industry that a lot of people are trying to read up on to try and get smarter. Why do you believe that they're not as green as maybe expected? Is it the amount of energy, the amount of water needed to create them, or are you pushing for another solution?
Look, industrial disruption clearly is an important dynamic, and lab-grown diamonds are part of that. It's one that may potentially reap ESG rewards, but as we know that some of these new players, their driver is not primarily economic. I would compare that a little bit to Bitcoin enthusiasts who pretend they could liberate the world from the constraints of fiat currency. We now know from the Bitcoin story that the cost of the digital mining could devastate the earth. So similarly here,
but Maria, I mean, there are not mines where you do dollar and euro. There is a line of people saying that actually you have blood diamonds because it leads to war, because it leads to warlords, because it's people going in the mine at great personal risk. Something that actually you don't see with Bitcoin.
Yeah, I would actually question that the diamond industry in the past 20 years has done a tremendous amount of work through the kimberlite process to make sure that we can show that the diamonds are responsibly sourced and produced. We are working together with De Beers, or separately with De Beers, but in line with De Beers on the nanotechnology to make sure that every diamond, and we have made a commitment, De Beers has made the commitment that by 2030, they will be able to show the provenance of every diamond that has been mined. So I think that that is largely the issue that clearly, painfully, the industry had to face and has done with very well. Now, with the energy consumption, a recent report by S&P True Cost shows that the diamond, artificial lab-grown diamonds, takes 350 kilograms of emissions to produce 1 carat. And that is potentially a lot more than what we do. Now, we are working on a very, very exciting research report that shows that there is a big potential for offsetting diamond mine carbon emission through carbonization of processed kimberlite. To put it simply, the tailings, the kimberlite tailings that remain after the process of mining bind with the CO2. And our preliminary findings show that we emit 2.5 times less than the ultimate goal.
Maria, so Alrosa, mines the natural diamonds. There's concern, you have concerns about the ESG credibility of these man-made diamonds. How much do man-made diamonds actually take away in terms of revenue from Alrosa? Do you see a split? How many more people are now buying man-made also because they're cheaper?
Look, there is clearly a very aggressive appropriation of ESG credentials. However, that industry remains very niche and very small. The prices of lab-grown diamonds have been on decline, given that there is a realization that it's an industrially produced good. So it's not a threat. We are clearly saying that the aggressive appropriation of ESG credentials is not appropriate. And if you wish, Francine, if we were to look broader in the ESG, through the ESG lens, we are facing the era of accountability, or new accountability for making the statement. So again, turning back, we need not to replace the earth, but to work to improve the earth. And I think the diamond industry, given its resources, is working extremely hard to make sure that we, mine responsibly. 95% of, for example, the water we use is recycled. 90% of energy that we use.
I mean, you talked a lot about the Kimberley, process certification scheme. How many of the world's diamonds are mined in that way?
Over 90%. So clearly, it's a certified, highly consolidated industry where De Beers and Alrosa mine in totality some 70%. So it is easier to trace and control. So again, Francine, this is the issue that clearly was a big issue for the industry to face, and it has faced it responsibly over the past 20 years.
Yeah. All right, Maria, thank you so much. Maria Gordon there, Alrosa's independent director, and of course we're also reaching out for comment from the man-made chiefs of some of these diamonds. Now, coming up, sticking to the script, OPEC Plus sticks to its planned production hikes. We'll get the latest on what it means for oil markets next. This is Bloomberg.
One of the jobs of an international bank is to comply with complex laws and sanctions laws wherever they're implemented. And that complexity has increased, but we'll navigate that as we have done so far, and we'll continue to do so going forward.
Hsbc Chief Executive Noel Quinn there speaking to us exclusively, and you can catch the full interview first on the Bloomberg terminal starting at 11 p.m. London time. Then, starting at midnight tonight, clips will also appear on Bloomberg TV and Bloomberg Radio and all of our other platforms. One of the very first, and actually the first interview since he became chief executive. Now, OPEC Plus avoids any drama. The group has agreed to stick to their existing plan for gradual monthly increases in oil production. It will bring 400,000 barrels per day of new supply from October. Now, the rapid meeting was a stark contrast to the drawn-out negotiations seen in July. Let's get more from our Bloomberg executive editor for energy and commodities, Will Kennedy. Will, thank you for coming on. It was smoother, actually, than we thought it could go. Is there some kind of alliance now, or do they just have better visibility about what the future looks like?
I think they were confident in raising production for a couple of reasons. Earlier in the summer, they'd got very worried about demand as
delta spread through the world, especially in Asia, which is the heart of global oil demand. Those fears have dissipated somewhat. Demand is holding up well. We saw some astonishingly strong demand numbers from the US yesterday, the EIA reporting a broad measure of product demand at an all-time high. And that gives them a lot of confidence that the global market is doing well, the economy is performing strongly, and needs more oil. And the other fact that will give them confidence is that there's still little sign of Iranian barrels coming back into the market. Those nuclear talks in Vienna appear to be in a bit of a quagmire. There's no Iranian oil likely in the next couple of months, so I think they've all felt like it was a good time to keep raising production.
So, well, did it transpire that they felt like they had better visibility on the world economy, or just in the shorter term?
Look, they're meeting every month, Francine, which I think gives them a lot of opportunity to carefully calibrate policy on the short term. So, if there is a sudden slowdown, they could change course. But right now, I think they are confident that the oil market is headed their way. I think one other thing that the market's increasingly going to focus on after this meeting is the extent to which every member can meet its commitments to raise production. Our tanker tracking survey yesterday showed that actually OPEC exports fell in August as some countries kept crude at home or didn't keep pace with their increases. And there are some countries in places like West Africa where the oil industry has taken a big hit from the COVID crisis, where it's not entirely clear that they can keep raising production. So it's all very well having OPEC having these targets. I think one thing we're going to be talking about over the coming months is to what extent they can meet them.
Well, what can you tell us about Ida? So for the first time, I think, in a very long time, there was a state of emergency also declared, around New York. Does that impact, is this kind of thing, it's not disruptive to oil at the moment, but is there any repercussions on that?
I think clearly there's going to be a lot of disruption to people moving around the New York area. It will probably have an impact, a very short-term impact on how much gasoline people use, but it may disrupt the supply of gasoline places in Louisiana. After the hurricane, we've seen some gas stations run short, and it's possible that might happen in other parts of the country. And of course, it may well have had an impact on power supply. That will become clearer this morning.
Well, thank you so much, Will Kennedy there, of course, in charge of energy and commodities. Now, this is what the markets are telling us. When I arrived in the newsroom a bit earlier on, well, actually a lot earlier on, about 5-6 hours ago, there was definitely a sell-off in technology stocks, especially in Asia. Now we've seen a little bit of a turnaround. This is partly because of some of the belief that the recovery will stay firm. European stocks now posting modest gains. U.S. equity futures cautious, but still on the rise. Now, this is the day before key U.S. jobs data. So that will shape bets on the path of Federal Reserve policy tightening. So that will have, of course, the biggest impact on the markets that we've had certainly this month. Well, not this month, but in the last 30 days. I always forget that it's September 2nd. Travel firms actually leading the stock 600 higher for a second day. Consumer non-cyclical and miners down. The 10-year U.S. Treasury yield steady at around 1.3%, and dollar holding a drop. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kailey Leinz out of New York. Don't miss our exclusive interview with the Hsbc Chief Executive, Noel Quinn. That's tonight. You can watch the full interview first on Bloomberg, on the Bloomberg terminal starting at 11 p.m. London time. This is Bloomberg.
The dollar is going to be one of kind of the messier stories because it's kind of in that battle between the safe haven and the growth and the recovery pictures.
One thing you don't want to do is to be out of the market. We do still see equities rising.
When policy in its various guises steps away from the US, from any major economy, the economy literally has a heart attack. So without temporary inputs from policymakers, the current state of the economy is unsustainable.
This is Bloomberg Surveillance, early edition with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, September 2nd. Our top stories today. President Biden vows to stop Russian aggression. He assures Ukraine's leader that the U.S. is committed to the country's sovereignty. State of emergency. New York and New Jersey are swamped by torrential rains caused by remnants of Hurricane Ida. And OPEC Plus bets on improving demand. The cartel and its allies stick with a plan to increase oil production. We'll talk with the global head of commodities research at Goldman Sachs, Jeff Curie. Now, we'll, of course, look at inflation through that commodity lens. Kailey, so I came in today and actually stocks were lower because of concerns about extra regulatory crackdown on Chinese tech stocks. And now they're kind of undecided. I wonder whether they're just waiting for that U.S. jobs report tomorrow.
We're all waiting for that jobs report tomorrow morning, Francine. 8:30 a.m. Eastern time on Friday. You definitely don't want to miss that number. But to your point about Chinese tech stocks, yes, regulators exercising a crackdown once again on ride-hailers like Didi, and yet the Hang Seng Tech Index largely shrugged it off. That said, it wasn't an overwhelmingly positive Asian session. You did have stocks lower in South Korea and Taiwan. Japan, though, did close higher by about 0.3%, while that Hang Seng Tech Index actually rose about 1.5%. So that rally continues. And of course, also lending support to Chinese equities more broadly is the PBOC pledging support for smaller businesses, which of course is support for the economy. And support for the Chinese economy is also a good thing for industrial metals demand. And as a result, you did see aluminum reaching a fresh decade high in the London trade, those futures up about 1.1%. I also wanted to point out in the bond market, New Zealand bonds, that 10-year yield is at 1.93%, which is the highest going back to April of 2019 on a closing basis. And in other asset classes, the South Korean won is your big underperformer in Asian FX, weaker against the dollar by about 0.3%. Now, here in the U.S., futures are in positive territory. Of course, it was big tech that led the way yesterday. We will see if that's the case again today. But right now, S&P E-minis up by about 0.25%. Not a whole lot of movement going on in the bond market, though. The U.S. 10-year yield still just shy of 1.3%. The dollar is weaker, and that may be helping oil off of session lows. WTI now up about 0.3%, even in the face of more supply from OPEC. They are sticking to their plan, Matt. Right now, WTI is trading at $68.82 a barrel.
Yeah, it's interesting to see such little movement in oil and to see it to the upside after you have all this supply come back online. Let's take a look at what's going on in Europe. You can see here we have green across the screen and not huge, bright green. In fact, in London, markets are a little changed, but it is a broadly better day. The stock 600 is higher as we see most of the national indexes climb. Take a look at the bunds. You can see the yield is coming down a little bit, but still with three handles. So still at a different place, really, than we have been the last few weeks, trading at negative 38.5 basis points. The euro stronger against the dollar, as is the pound, but not a lot stronger. I think the markets really, Francine, are waiting for this jobs number, as you and Kailey were talking about, waiting to see what kind of signals the Fed is going to be plugging into its model going forward. That's really the only thing that matters until we get any kind of tax legislation through.
The only thing that matters, I couldn't agree more. The other thing that matters, at least especially to 200,000 households in the U.S. that are now without power across the Northeast, is the remnants of Ida ripping through New York, New Jersey, and across the Northeast. So a lot of people, I know, Kailey, haven't been able to come to work. I mean, some of the videos of the flooding posted on social media is showing major thoroughways, airport terminals, baseball stadiums, and also subway stations, turned into pools.
Yeah, it has been quite dramatic in many areas, Francine. I will say anecdotally, my commute from lower Manhattan up the east side to here at Bloomberg headquarters was actually okay this morning. The east side of Manhattan not doing too bad. But if you're in the outer boroughs or coming in from New Jersey, that is where you might run into a problem with your commute this morning, Matt.
Yeah, well, I'm glad I'm not dealing with that right now. But if I were, I would have a gigantic truck with huge 37-inch tires and just plow straight through it. Although I'm not sure if I would need an amphibious vehicle, Francine, because it does look like the flooding is pretty deep.
Yeah, maybe a submarine. This is what else we're looking at today. China's President Xi set to speak at a services trade summit in Beijing. Investors will be watching the comments closely for any hints on regulatory moves President Vladimir Putin begins a 4-day visit to the Russia Far East for the Eastern Economic Forum. EU foreign ministers meet in Slovenia for informal discussions. They're expected to discuss the bloc's role and position in the world. And we also get some U.S. economic data, including trade balance and initial jobless claims. Now, over to Washington, and President Biden has assured Ukraine's president that the U.S. would counter Russian hostility towards his country. The two leaders met for the first time on Wednesday at the White House. Let's get straight to Jack Fitzpatrick, Bloomberg government reporter, joining us from Washington. Jack, this was almost a litmus test to see how the U.S., after the retreat from Afghanistan that had a lot of allies worried, would deal with Russia.
Yeah, and there really wasn't anything surprising. In fact, this would be maybe less of a newsworthy meeting, if not for the recent history of the back and forth between former President Trump and Ukrainian President Zelensky and the temporary withholding of U.S. aid to Ukraine. The meeting went as planned. There wasn't a massive amount of news other than pretty standard promises of U.S. backing for Ukraine and sort of a broad promise of pushing back on Russian influence. That is not a surprise. Even in what we see in Afghanistan, Biden has made it pretty clear that a little bit of a less of a focus on the Middle East, more of a focus on pushing back against Russia, and obviously a focus on China are the basics of his foreign policy agenda. So this was probably mostly newsworthy just for the fact that the meeting happened without anything going wrong after all the drama that we saw in the last presidential administration.
So, Jack, that's the executive branch. Let's talk about the judicial, because the Supreme Court last night, 5-4 vote, refused to block that Texas abortion law, banning abortions when you can hear a heartbeat around 6 weeks. This is a break from precedent for the Supreme Court. What are the broader implications even beyond Texas?
Well, this could very well potentially conflict with Roe v. Wade, and the concern is that this is a sign that the court decided to stay hands-off, not on the merits itself. This is the decision by the Supreme Court to not issue a stay and not block in the short term the Texas law until they actually rule on the constitutionality of it. But the apparent conflicts with Roe v. Wade and the underlying assumptions that women have a right to get an abortion in the U.S., that's the issue. And it's really reflective of the concerns that you've heard on the left about the rightward drift of the Supreme Court, with particularly the Brett Kavanaugh and Amy Coney Barrett confirmations under President Trump. So there's not a lot that Congress or the executive branch can do there right now.
Jack, thank you so much. Jack Fitzpatrick there of Bloomberg government reporter. Now, in tech news, Apple will allow some app developers to link their software to external websites for payments and avoid a 30% fee. Let's get more on this with Matthew Bloxham of Bloomberg Intelligence. Matt, I mean, this is basically about regulators cracking down, Apple trying to do something about it.
Yeah, that's right. And this is specifically in response to a Japanese Federal Trade Commission review. And it'll come into force next year. It affects about 10 to 15% of the revenue that Apple generates from its App Store. So it's a relatively small amount, but yeah, it's an important step forward. And there's a lot of investigations going on across the world into Apple, Google and other tech giants. So I think we're going to see a lot more of these coming. And actually, I think India's just opened a similar investigation for that market.
Well, we have another suit coming for Google, apparently.
Yeah, that's right. An investigation into their digital ad business, which is obviously the vast majority of their revenue, and they're a very dominant player in that market alongside Facebook. So again, I think it's a similar theme. These are all platforms. They've all got an incredibly strong position in the market, dominant. I think it's a question about whether they've been abusing that dominance and what the best approach going forward is. We could see tougher regulations. We could see big multi-billion-dollar fines. I think in most cases, the big tech giants are going to shift their practices to kind of head off the most severe penalties they may face.
Matt, thanks so much. Matthew Bloxham there at Bloomberg Intelligence. Now, Bill Gross is trash-talking bonds. Bloomberg's Ritika Gupta has more from the one-time Bond King's latest outlook. I mean, he says they're trash, Ritika.
Yeah, he does, Francine. He says the bonds are investment garbage, just like cash. And he says with yields sitting so low, we're just shy of that 1.3% level on the 10-year, that the funds that essentially buy them are essentially, well, worthless. Now, we know he's been a bond bear for a while now. He sees the 10-year going to 2% in a year. He really says there's nowhere else to go but up. And JP Morgan have also, he's not alone here. They also see the 10-year going to that 1.9% level. But he really points to those supply and demand side dynamics, the Fed playing a big role here now that it starts to taper, because, of course, they make up about 60% buying of that net Treasury issuance. And he also points to the fiscal deficits that we have that are at least $1.5 trillion. So he says on those grounds that Treasury issuance will remain elevated.
All right, so Bill Gross says you can't buy bonds. Does he think you can buy stocks here, Ridicka?
Yeah, Kailey, he says that really stocks could also go in that garbage can. That's if we don't get earnings that are in the double digits. And this comes really at a time when we do see concern about lofty valuations on the S&P 500. If we actually look at the valuations, they're the highest going back to the year 2000.
All right, Bloomberg's Ridicka Gupta, thank you so much. And I want to stick with the markets now and take a look at some stocks moving in pre-market trading here in the U.S. One of your outperformers to the upside is ChargePoint, of course, an EV charging company, up 11% in early hours after raising its forecast after the bell last night. Jefferies calling both the second quarter and that guidance strong, so that stock is getting a lift. To the downside, though, 5 below, the discount retailer also reported after the bell its second quarter revenue missed expectations. As a result, that stock is down 9% in early hours. And finally, one more company, Chewy, of course, the online pet supply retailer, somewhere I might shop if my new husband lets me get the puppy. Jury's still out on that. It, however, gave a disappointing outlook. The company's CEO, it's still out. Stay tuned. I will have updates frequently. The company's CEO says it's still really hard to judge consumer behavior and demand because of the pandemic. Investors don't like to hear that, so that stock also down 9% before the bell, Francine.
Yeah, I feel like I'm, taking out a second mortgage just to pay for my puppy's new food. And also, once you're married, you're in charge, Kailey. That's just right. Bottom line. So you are definitely getting a puppy. Coming up this hour, Jeff Curie, Goldman Sachs, Global Head of Commodities Research. We'll talk oil, and of course, we'll talk energy in general. And then a little bit later, an exclusive interview with the Hsbc Chief Executive, Noel Quinn. One of the first times he's speaking since he became, Chief Executive of HSBC. You can watch the full interview first on the Bloomberg terminal starting at 5 p.m. in New York, 10 p.m. in London, and then an hour later on Bloomberg TV and Bloomberg Radio. Here's a quick preview.
One of the jobs of an international bank is to comply with complex laws and sanctions laws wherever they're implemented. And that complexity has increased. But we'll navigate that as we have done so far, and we'll continue to do so going forward.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, even though we continue to hit record after record after record in the stock market, certainly on the S&P 500, that doesn't mean that investors aren't hedged. In fact, if you take a look at the put-call ratio, it is near the highest level that we've seen it in years. Here is a chart for those of you on radio. I'll just go ahead and walk you through. Welcome. Thank you very much for joining us on this. Wait, is it Thursday? It's Thursday?
Yes,
Thursday. On this Thursday,
we're
up as you can't see, but those of you watching on television can see. We're up at the highs that we saw at the beginning of 2020, at the end of 2018, beginning of 2019. So investors are prepared for any downside if it may come. Not through shorting, obviously. That's out since the Reddit crew joined in, but we are seeing people hedge in a number of ways, and the put-call spread is one of the ways you can see it. Francine?
Miller, as your personal calendar assistant, how am I doing?
You're doing great in so many different ways, but yes, also that.
Let's get straight to Noel Ali, Bloomberg Markets live editor, to talk about the great terminal chart that Matt had, and also to talk about what we are expecting from U.S. jobs. I mean, is the market going to be quiet today just because we want to know that figure that could change the way we look at tightening from the Fed?
Well, look, it's all about jobs, as you've said. A couple of months ago, we were talking about tapering, and then the conversation went to inflation, and now we're here. We're at the core of the U.S. economy, at least in my opinion. So we've got the jobless claims coming in later today. We had ADP figures yesterday disappoint again, but the thing to note here is they did diverge. They've been diverging from NFPs since May. So I wouldn't take that as you know, the trial for NFPs, but I guess we'll wait and see.
Yeah. I have to tell you that having done this for 20 years, the numbers diverge and converge, ADP and NFP, constantly. So you really can't use it as any kind of decent guide. In terms of the jobs number tomorrow, what are we looking for, Noor?
Well, the expectations right now so far are that we are expecting a bit of a slowed from last month. It's coming in at about 725,000 compared to 943,000. But I want to tell you, though, that expectations last month were completely off the chart there. It was just, the number just massively beat. But I do have something really exciting to tout here, and that is the function Whisper on the terminal. So that's WHIS, and that gives you what market whispers are anticipating the numbers to be. So yesterday, when I was looking at the number, it was a lot higher than the surveyed number. Now it's dipped after ADP figures, and terminal clients can actually put in their expectations as well.
Super cool. Yeah, that's what I think is key. So this, not only does it give you a look at what the market is anticipating, but it also allows you to compete against the other banker bros and sisses in the market, right? Because if you win, if you beat everybody else, that glory can be yours.
Oh, yeah, absolutely, 100%. And look, the thing to note about the U.S. economy at the moment, it is inherently a jobs-focused market. I mean, the oldest thing that I remember from the World War I posters are, you know, Uncle Sam calling people to get recruited. And right now, the post-pandemic American could possibly be thinking about jobs very differently than they did. So they may look to Amazon for delivery jobs rather than manufacturing jobs that were declining according to yesterday's ISM figures as well.
And I'm wondering how all of this translates to the bond market. We were talking about Bill Gross saying bonds are trash, yields have nowhere to go but up. Could a strong jobs print be the catalyst for higher yields?
Well, you know, like my answer to Bill Gross is not an answer, but part of perhaps the persistence of the conversation here was James Carville back in the 1990s, and he's Clinton's political advisor, who came out and said, you know, if I'm ever going to be reincarnated, I want to come back as the bond market. And so it just shows you how intimidating that kind of market would be, that it would intimidate not only a sitting president, but a whole political party in the U.S. as well. Look, it's, yes, yields are quite... Yeah, absolutely. Yes, yields are much higher right now. But the thing to know as well is that the Fed, I don't think the Fed is just going to wake up one day and decide, we're just going to go ahead and sell everything that we've just been buying. You know, the Fed has changed its course into how it talks to markets. We remember how the 2013 taper tantrums happened, and I think the Fed is trying to avoid that in their message. They're being a lot more cautious in their actions and their behaviors, and I don't think that we're going to see, you know, bonds just fall off the cliff. I think yields have room to go lower.
I mean, I do feel like Matt Miller actually thinks he is the bond market as well. The Bond Market King by Matt Miller, and we will actually take bets on where we see non-farm payrolls a little bit later, and then we'll post it maybe on air as well. What does it mean for dollar?
Look, a downshift trend in the labor market right now does not bode well for the dollar. Why? Because that may mean tapering may actually be delayed, or it may be a lot more dovish. It may not come as hawkish as many expect. So I was actually a dollar bull, you know, just early on in the summer. I was like, anything the Fed does, that's it. But I'm just now turning. One thing to look out for, though, tomorrow is commitments of traders, and that gives you what their short and long positions come out. They're usually up until Tuesday of the week, and they're released on Fridays. So they may give us an indication of how the market priced Powell when he spoke last Friday, and then next week's obviously a reaction to the NFPs.
Noor, thanks so much. Noor Al-Ali there of Bloomberg Markets Live. Now, coming up on his new book, The American Experiment, Carlyle Group co-founder and co-chair David Rubenstein. That's at 7:30 a.m. in New York, 12:30 p.m. in London, and this is Bloomberg.
is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And a think tank says about 2.1 million jobs in the UK are still affected by the coronavirus pandemic. The Institute for Public Policy Research warned of what it called a hidden jobs gap, referring to positions that remain furloughed or lost. The British government is preparing to end its flagship wage support program at the end of the month. Lawmakers in New York have extended the state's freeze on evictions and foreclosure through January 15th. It was supposed to have ended 2 days ago. The move will provide relief to homeowners, renters, and small businesses that have struggled during the pandemic. In China, ramping up financial support for small businesses hit by the pandemic. The PBOC will provide more than $46 billion of low-cost funding to banks so they can lend to small and medium-sized companies. The economy has shown further signs of a slowdown in the wake of more virus outbreaks and tight property controls. And Bloomberg has learned that Tesla had to temporarily halt production at its factory in Shanghai last month. Blame it on the global shortage of semiconductors. The automaker didn't have enough electronic units. The stoppage lasted for about 4 days, Francine.
Yeah, I mean, one of the things that, of course, we'll talk about at length. Coming up, Jeff Curie, Goldman Sachs, Global Head of Commodities Research. We talk oil, we talk energy, we talk, of course, IDA. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Matt, the market really waiting for the U.S. jobs report. So futures are pointing up a little bit, European stocks as well, but actually there's not much news that they can, take a firm handle on.
Yeah, no, you're 100% right. And we're starting to see a little bit of a mixed market here in Europe. Not big moves either way, but I now see the FTSE is down, the IBEX 35 is down in Madrid, the FTSE MIB is down. Where do they trade that? Somewhere in the boot. So it's not as if everything here is gaining, and it's not as if futures are up either across the board, right? Because Dow futures are down too.
Yeah, and that's really playing out in the markets, Kailey.
It is, Francine. It is still a positive session in both Europe and the U.S., as Matt says. The Stock 600 only up about 0.2%, so not a massive move to the upside, but still it's positive territory. You have energy, healthcare, travel and leisure, some of the sectors doing well within the European session. Here in the U.S. yesterday, of course, it was big tech that really outperformed. And once again, Nasdaq 100 futures are higher by about 0.25% at this point in the futures session. In the Treasury market, really not a whole lot going on. As Francine said, really just a market waiting for that non-farm payrolls report tomorrow at 8:30 a.m. Eastern time. Ahead of that, the 10-year yield sitting right now at 1.29%. And then I also had to point to Bitcoin, up about 3.3% today. It was north of $50,000, a level it hit back in August, but couldn't close at. We will see if it actually can close north of that $50,000 level today, because it would be the first time that has happened since back in May. Nonetheless, 50,000 or 49,856. You are seeing crypto-related stocks in pre-market trading moving to the upside as well. The likes of Bit Digital higher by about 5.8%. You have Marathon Digital and Riot Blockchain higher by about 4% each, and even Coinbase, of course, the crypto exchange, higher by about 2%, Francine.
Yeah, talking about crypto exchanges, we have a big breaking news actually out of Singapore saying that Binance may be in breach of Payment Services Act. Now, this is one of the only regulators that I remember coming up saying that actually they have concerns about Binance simply because other regulators are saying, I'm not exactly sure what I'm looking at. So we heard from the Bank of England and the UK just weeks ago saying actually because it's unclear where they're headquartered, it's very difficult to look at some of the transactions that they worry about. So it seems that, Singapore now saying that it's something that they're looking at because they're in breach of a Payment Services Act.
People are always afraid of what they don't understand. Have you noticed that?
Normal, no?
Yeah, that's how it goes, I guess. We got to get CZ back on the program, by the way, and talk about this a little bit, because he has done so incredibly well in this business, but I think it takes some really big regulatory risks. I mean, Singapore is obviously not the first country that has been concerned about what's going on at Binance. So he's made himself a billionaire, and maybe that's how, right? But now he's got to figure out how to work with authorities in order to keep that money.
Yeah, and to your point, Matt, this isn't just Singapore. It's not just the UK, as Francine mentions. It also has gotten scrutiny here in the US, in Thailand, in Malaysia, in Japan. A lot of different countries' regulators are looking at Binance. And of course, this brings me to a question of just crypto regulation broadly, because it has been such a new space for a long time. People said, hey, regulation is exactly what the crypto market needs, but the right kind of regulation. And the question is whether this is the right kind of regulation, Francine.
Right, and a lot of regulators are saying, actually, I don't exactly understand it yet. I'm not the person to regulate it. Maybe it'll come with time, or maybe they just need to get a lot smarter about cryptocurrencies fast. Now, coming up next, we'll talk about commodities with Jeff Curie, Goldman Sachs Global Head of Commodities Research. Usually, I think he also talks about cryptocurrency, so we'll ask him maybe about Binance. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today on Balance of Power, Eurasia Group founder Ian Bremmer. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, and Kailey Leinz in New York. Now, oil declined after OPEC Plus stuck with a plan to boost crude production. The cartel maintained the plan for gradual supply hikes as demand increases. Joining us now is Jeff Curie, Goldman Sachs Global Head of Commodities. Jeff, thank you so much for joining us. Why did the cartel actually, I mean, it was a quick and easy agreement from OPEC Plus. Is this because they found some consensus, or is it simply because demand looks good in the next couple of months and they're not too worried about the world economy?
Well, I think they're looking at trying to get inventories back down to pre-COVID levels, and the rate at which they're bringing supply online with relatively consistent estimates of demand, suggests they're on target for the end of this year of being completely normalized. And now, in terms, which is why they talk about the April 22 as being the point which they can exit the agreement. But I think to put this in context in terms of the pricing of the market is that. The 400,000 barrels per day per month, you put that in the context of the disruptions around Ida, that means you would basically erase this, within 8 days. And I think that's really what we need to be thinking about is what's going on in the U.S. right now, because you're not getting any incremental supply from that region.
I mean, crude, Jeff, has rallied about 40% this year. What's the optimum level? Does it stay amongst the $70 to $75 mark?
I think we're going to learn what that new equilibrium is. We have not seen a big uptick in investment drilling in the U.S. Our target is we're going to $80 a barrel in fourth quarter. As we spike above 80, we're going to find out if we start to get that big uptick in drilling activity that many people would have thought would be happening, today in the $70 barrel range. Remember, we almost were at 80, going back 6 weeks ago. So I think, the jury is out on where that new equilibrium is, because let's think about all the factors that are driving up, the underlying cost structure. It's everything from, labor costs, transportation costs, cost of capital, particularly the cost of capital, given the restrictions around ESG investing.
Yeah, we have a viewer writing in with a question, Jeff, that I think it connects to that as well, asking about overall energy markets at high prices not seen for some time. A, do you see that continuing, and B, does this fall then into inflation readings going forward?
Well, our view, this is just the first ending of a multi-year, potential decade super cycle in commodity prices, driven by three fundamental themes. One is, this policy of redistribution. We're seeing it all over the world, in particular, in China. They just, they call, they just, it was last week, I think, what is it? Common, can't remember the name of the term that they use for it, but we see it in the U.S. with that $3.5 trillion potential extension of the budget. The other big theme is what's going on in the environment. This war on climate change is having a huge impact on gas prices, particularly in Europe. You have gas prices in Europe trading in double digits per MMBTU, driving up coal prices. Gas prices are trading at parity with diesel. We haven't seen that since 2006. Gas prices in the U.S. just topped $4.50 per MMBTU for, again, the first time since 2014. So this is not just an oil story. We're seeing it across the board, particularly given the environmental. And then the other big issue is this whole idea of resiliency in supply chains around, what do you want to call it, the Cold War with China. We have, onshoring going on in the U.S., transportation bottlenecks. So, again, we think this is just the beginning of, a potential, multi-decade type of environment, or multi-year potential decade type of an environment.
We have a great story on food supply chains on the Bloomberg. Fabiana Batista, Megan Durson, and Sibylla Gross write that in Vietnam, the army has to assist with the rice harvest. In the UK, they need to dump out milk because the truckers aren't coming to collect it. In Brazil, it takes 120 days to reap the coffee harvest rather than the usual 90 because they just don't have enough people. Is the food inflation and even the shortage of labor in that market going to be a problem?
Well, at least over the next couple of years. Food is different than oil or metals. Oil or metals, you have to make long-term, large-scale investments to solve the problem. In food, you make investment in acreage and investment in yields, you'll end up being able to solve it with a good cooperation of weather rather quickly. But even there, we look at the acreage, it's also being restricted in the most recent acreage report in the U.S. because, again, poor returns across the sector for quite some time. So it's not just these labor, or let's call it variable cost issues that you're referring to. There's also more structural factors at play. We call it the revenge of the old economy. Poor returns in the old economy going on anywhere from 5 to 10 years now has restricted the ability to grow supply at the context that you have the stars. Big uptick in demand is creating these tight markets. Again, underscoring why this is just the first innings of a multi-year story.
Let's talk more about the industrial metals because China's metals industry group yesterday said aluminum has gotten entirely disconnected with the fundamentals with the rally that we have seen. Do you think it can persist?
Absolutely. The thing with aluminum is there's a paradox in the sense that it is going to be critical. It's a critical green metal to solve climate change issues. So it's got to have that demand, but it's one of the most polluting metals to create because you have alumina, which has got the red mud associated with it. China has huge emissions because remember, it takes a lot of power to produce aluminum. And as a result, you get a lot of carbon emissions out of it. So you need it to solve climate change, but it creates the climate change problem, which means you're going to be in a rock and a hard place to produce this stuff. And then you have to ask the question, who's going to produce it?
So yeah, that's a classic example of a catch-22, I think, Jeff. And then talking about the precious, where are we going to find a catalyst for gold?
All right, when we look at gold, there's three legs to the story. One is, Western investment demand, and I think that's the one you're referring to, that's the weak link. But the other two are quite strong. Central bank demand is quite strong across the board right now. What's different about central bank demand? It's not just the Turkeys and the Russia that's out buying gold due to political concerns. You have like the Polands of the world buying it for diversification. So it's large scale investment from central banks. Plus we look at the arbitrage into China, very strong physical demand going into China. So the only weak link is the Western monetary demand. And I think there you need to have a focus on what inflation risk. And I think a rally in oil prices above $80 a barrel could be that catalyst that gets people back into this market. Our target on gold is $2,000 an ounce.
Jeff, the underlying question for everything that you've just talked about is, of course, what do we do with China? Is the third quarter data something of ugly, a symptomatic of something that's quite sinister? Where do you put China right now?
Near term, China's going to underwrite any potential weakness right now, particularly off the back of the weakness that was created this summer with the Delta variant. But I want to be careful about the weakness. The weakness that we're seeing is very idiosyncratic and intended at a very industry level. So let's take like steel. Steel demand in the first half of this year was running like plus 8%. Most recently, it's dropped to minus 5%. People go, oh, I'm very concerned. But steel is one of those sectors that they're targeting for environmental reasons to shut it down because it's very, it creates a lot of emissions. But also the weather was not cooperative to construction over this summer, and that also created that decline. So now that you have, there's a lot of potential for special purpose bonds at the local level that can be used for infrastructure spending that can create that uptick as we go towards the end of this year. I remember the term that China uses, common prosperity. And that common prosperity means that they're going to be focused on these redistribution themes that you're seeing in places like the United States and in Europe. In Europe, here in the UK, they call it leveling. That's going to create a lot of demand for commodities as we look out into the forward. So China, I'm not worried about. But here's one last point I want to say about China is the world's not China-centric anymore. The world is global in the sense that U.S. and Europe are very much part of this story, and you can even see how copper prices are tracking U.S. and European PMIs now, no longer Chinese.
Jeff, you have common prosperity in China. You've got leveling, or the typical sort of democratic socialism that we have here in Europe. In the U.S., in regards to tax policy, and we talked to this about David Costin, what do you expect and how does that change the picture?
Well, when we look at the tax policy, it's not, obviously it's going to have a big impact in David's space because it's going to impact it directly. But when we look at it, at the space for commodities, and here's a really important point about commodities. Physical markets are driven by volume, not finance. In fact, I really want to take a second to explain this because it's critical. Let's take David's markets. They're financial markets. They're driven by how many dollars come into those markets. Let's take commodity markets, physical markets like oil. How do we calculate for bullish oil? The barrels of oil consumed has nothing to do with money or money flows or anything like that, just volume. And so when we think about high income groups, what do they control? Wealth and income. They can create financial inflation. They can drive David's markets. Can they drive the commodity markets and physical markets? It's numerically impossible. There's not enough of them. The only group that can drive commodity markets in the physical markets are going to be the low income groups. And so when we think, because they have the volume. And so you can think financial markets driven by higher income groups, physical markets are driven by the lower income groups. And so when we think about these tax policies and you think about redistribution going on around the world, it's going to create that volumetric demand growth that drives commodities and physical markets.
Jeff, let's just quickly talk about a market that is decidedly not physical, just digital. Bitcoin dancing around $50,000 once again today. What is the Jeff Currie take on crypto?
Well, when we think about crypto, is that it's a network. The value of the network is what drives the value of these coins. The coin unlocks the network. They're decentralized. The decentralized internet. I like to think about what is Apple iOS. Apple sits at the top, and you have the iOS down there, and you have all the different application producers that report into Apple. All these different cryptos do is they take out the Apple, it's decentralized, and it allows, and the coin is used to create the wealth to trade within that ecosystem. Do I like them as a commodity? Yeah. It's just like oil or one of the other, in fact, we like to call it, much more closely akin to copper, digital copper, because it is pro-cyclical and it trades that way. So I wouldn't think about it as being digital gold. It's not digital gold. One last point. Gold can exist outside of the network. Oil, copper, and Bitcoin or Ethereum, they need their network. Think about oil. It has no use without a car. Bitcoin has no use without the blockchain. Gold is different than all those. Gold you can bury in your backyard.
Jeff, thank you so much. Jeffrey Currie there with some brilliant analysis, all fired up. Goldman Sachs, Global Head of Commodities. We'll have plenty more on the markets shortly. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, Bill Gross is trash-talking the bond market, literally. The PIMCO co-founder says long-term Treasury yields are so low that funds that buy them belong in the investment garbage can. Joining us to discuss this and more is Barry Ritholtz, Bloomberg opinion columnist, Ritholtz Wealth Management chairman and CEO, as well as host of the very popular podcast, Masters in Business. So, Barry, what do you think about the erstwhile bond king trashing the paper?
So first, I'm a fan of Bill Gross, and while he had kind of a bad ending to his long, 40 years at PIMCO, everybody forgets what a fantastic streak he was on for the first, 3 decades or so, and built PIMCO into $1 trillion business. So kudos for him. We've watched people say that bonds are junk and this is the end of the bond bull market that really began back in 1982 when Volcker broke the back of inflation. And, all my technician friends are fond of pointing out that, hey, the trend is your friend. And if you want to just keep guessing when the trend is over, you can. But so far, being on the bullish side of the bond market has been the moneymaker. Last year was, a modest, flat to soft year in bonds, but by and large, rates have continued going lower and lower, and it's hard to say that the bond bull market is definitively over. The yield we've seen over the past 12 months suggests that, hey, maybe this is the end of it. But Barry, Gross could be right, but people have the landscape is littered with the bodies of strategists calling for the end of the bond bull market.
But Barry, are you saying he's wrong, period, or is he, not wrong, but it's a matter of timeline of how quickly that happens?
Well, I mean, the rally in bonds that began decades ago took a pause last year, so maybe he's right, but it's not the first time we've seen this, and until the Fed ends QE, ends ZERP, starts normalizing rates, we could be stuck here for God knows how long. Mm-hmm. And P.S., I was impression like everybody else back in 2018, hey, maybe the Fed is serious about normalizing rates and getting us back to, a crazy number like 2.5% Fed funds yield. Yeah. And then, things went off the rails. It doesn't take a whole lot of economic issues to get the Fed to cut these days.
Barry, we just have about a minute left, but are the equity bears going to meet the same fate as the bond bears?
Well, so far, are there really any bears left in equities?
It seems like Citi sees this going to 4,000.
All right, good for
him. There's one.
So here's the issue that I think we run into on the equity bear side. People misunderstand this bull market. They misunderstand how long bull markets run in stocks. And I date this bull market, the secular bull market, to when shares broke out to 2013, to new highs past the trading range. There's a ton of capital, not just Fed largesse and not just CARES Act trillions of dollars coursing through the system. There's a ton of capital looking for a home. And until I see something and profits are at record highs, it's hard to be bearish in that environment.
All right, we'll have to get you back on with that call. Barry Ritholtz of Bloomberg Opinion. Now, an exclusive conversation with the Hsbc Chief Executive, Noel Quinn. That's a little bit later. You can watch the full interview first on the Bloomberg Terminal, starting at 5 p.m. in New York, 10 p.m. in London. And then an hour later, you'll also see clips on Bloomberg TV and all of our platforms. This is Bloomberg.